Hello everyone, I am Pradeep from Indian Institute of Management Tiruchirappalli. In this video, I'll be talking about non-performing asset crisis and the Financial Resolution and Deposit Insurance Bill. This video is based on the article by Mr. Rohan Abraham in The Hindu on December 9, 2017. While caution is thrown to the wind when talking about mutual funds and stock market, bank deposits are considered to be a safer option. Fiduciary trust, the underlying basis on which finance works, grants that money deposited in a bank is shielded from the vagaries of the market. However, that could change given the passing of Financial Resolution and Deposit Insurance Bill. The government has proposed this legislation for the recapitalization of the banks. Despite being awarded a positive look by the credit rating agency Moody's Investor Service, India's financial institutions are in need of resuscitation given the pileup of non-performing assets that threaten to hinder growth and jeopardize the health of both state-owned as well as private banks. As of now, the stressed assets held by Indian banks amount to around 10 lakh crores, which is roughly twice the GDP of Sri Lanka. Reserve Bank of India regulates the supply of money in the country. For this end, they use tools like cash reserve ratio, the statutory liquid ratio, the repo rate, and the reverse repo rate. Bad loans arise when banks make poor lending decisions. CRR is the money that banks are required to deposit with RBI for which they will not be paid interest. At present, RBI has fixed this rate at 4%. In addition to this, banks have to deposit a portion of their money in relatively safe assets which are easily saleable, such as government bonds, securities, or gold, to generate liquid cash in the event of the run on the bank. The current SLR is 19.5%. This means out of every 100 rupees deposited in a bank, 4 rupees is parked with RBI and 19.5 rupees in the assets like gold or bonds. While the bank is free to lend the remaining 76.5 rupees to corporate or retail borrowers, the interest gained on such loans is used to compensate the bank's customers as interest payment, and the remainder is bank's current profit. NPAs arise when banks lend to clients who default on their repayment. The Financial Stability Report released by RBI states that India's gross NPA stands at 9.6%. This figure is the sum total of all stressed assets held by lending institutions in the country, including cooperatives and small banks, in addition to government and private banks. India has the second highest NPA among the major economies of the world. Only Italy, with 16.4% NPA, has more stressed assets than India. China, whose economic growth is largely fueled by borrowings, has only 1.7% NPAs according to the International Monetary Fund soundness indicators. RBI's Financial Stability Report names the basic metals and cement industries as the most indebted, with 45.8% and 34.6% stressed assets respectively. Despite the recent GDP numbers, which point to lukewarm growth, the metal industry continues to be hamstrung by slow demand and cheaper imports. The construction, infrastructure, and automobiles industries also account for a sizable chunk of banks' NPAs. According to the Finance Minister Arun Jaitley, the gross NPAs of public sector banks increased by 3 times in the past 5 years. Likewise, the gross NPAs of private banks witnessed an increase of 278%. The SBI leads the list with highest NPAs with nearly 1,88,068 crores of stressed assets. Punjab National Bank and IDBI Bank follow suit with 57,721 crores and 50,173 crores of gross NPAs respectively. However, among Indian banks, IDBI Bank, which has 24.11% of gross NPAs, tops the list for lending institutions with highest exposure to liabilities. Indian Overseas Bank has 23.6% NPAs, while fellow private lenders like Kotak Mahindra Bank and HDFC fare better with only 2.58% and 1.24% of gross NPAs. State Bank of India, which is saddled with most stressed assets in absolute terms, has a gross NPA of 9.97%. According to the Finance Minister Arun Jaitley, the gross NPAs of public sector banks increased by 3 times in the past 5 years. Likewise, the gross NPAs of private banks witnessed an increase of 278%. The SBI leads the list with highest NPAs with nearly 1,88,068 crores of stressed assets. Punjab National Bank and IDBI Bank follow suit with 57,721 crores and 50,173 crores of gross NPAs respectively. However, among Indian banks, IDBI Bank, which has 24.11% of gross NPAs, tops the list for lending institutions with highest exposure to liabilities. Indian Overseas Bank has 23.6% NPAs, while fellow private lenders like Kotak Mahindra Bank and HDFC fare better with only 2.58% and 1.24% of gross NPAs. State Bank of India, which is saddled with most stressed assets in absolute terms, has a gross NPA of 9.97%. It should also be noted that India's bad loan problems could hold economic growth through ransom, while economic output has lagged owing to disruptive policies such as demonetization and implementation of goods and service tax. The lackluster performance of India has pulled down banks with greater defaults from corporate clients. The gross NPA ratio has spiked from 5.8% in 2015 to 9.6% in 2017, while economic growth has slumped in the corresponding period. The Financial Resolution and Deposit Insurance Bill is the latest attempt to recover bad loans. Previous attempts to recover bad loans have been moderately successful. To recover outstanding loans, a slew of legislations were instituted. Debt recovery tribunals were also set up to fast-track proceedings. The Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act empowers banks to auction assets and properties that were submitted as collateral while sanctioning loans. Under this act, 64,519 properties were seized in the financial year 15-16. However, the value of the recovered assets only constitute a part of NPA. The FRDI bill is aimed at ensuring the money of a bank's depositors in the case where the bank would have to be liquidated. However, some of the provisions of the draft have drawn the anger of the depositors and the bank employees alike, since it gives the government absolute power in deciding the fate of the banks if they undergo liquidation. While debt restructuring and ensuring the robustness of financial institutions was previously the domain of RBI, the bill gives the government overweening powers. The bill proposes the setting up of a resolution corporation, and the board consists of a chairperson, one member each from the Finance Ministry, RBI, SEBI, Insurance Regulatory Development Authority of India, and the Pension Fund Regulatory and Development Authority. Plus, it includes 3 full-time members and 2 independent members, both of whom will be appointed by the central government. This implies that 6 of the 11 members of the board will be nominated by the government, giving it the final say in decision making. While the insurance covers only 1 lakh of the principal, the remainder of the sum deposited with the bank will be converted to tradable financial assets which can be redeemed. However, their value will not be immediately commensurate with the deposit amount, since if a bank has filed for bankruptcy, the value of assets held would have also eroded. The other countries that have experimented with bail-in clause have not fared well as well. The FRDI bill, which is currently pending in Parliament, is likely to be introduced sooner.